What sort of conversations are you having and what advice are you giving to clients that don't know how long to fix in their mortgage? Hi guys. So we're back today to talk more about mortgages. I think one of the big topics at the moment that we're finding with clients is how long do I fix in my mortgage for, whether it be 2 or 5 years. Rav, I'll start with you. What sort of conversations are you having and what advice are you giving to clients that don't know how long to fix in their mortgage?
Most of the time, the customers don't have a clue on like how long to fix for. Generally, they want the cheapest, right?
Yeah.
But cheaper obviously is not better. So we generally look at what their circumstances are and what their future plans are. For example, if they're planning to go self-employed in a couple of years' time, then perhaps it's better that they fix it for 5 years. So it's easier for them to remortgage whilst they make build their pipeline or book, self-employed book. Some customers have appetite to risk, and therefore they want to be on cheapest rate. So then they're a bit clued up on the market. They see the rates are going down, so they don't want to be fixed for a longer period. So where it's down to appetite of risk. So, if in that scenario, it would be a 2-year fix and then be adventurous and hope for a better rate and then fix it for another 3, 5, depending on how the market is and what the sentiment of the market is. So really, it comes down to what your current circumstances are and what your future plans are.
Cool, thanks, Rav. So obviously that's what you said there about their future circumstances. That's always something that they should factor into any decision before they do a 2 or 5 year fix.
Absolutely, right. So, and it's not just about being self-employed. It's about like if you're planning to have kids, whether you're planning to move home or whether your job might take you to a different location. So all these things in terms of like, although no one knows how much will actually materialize, but if there's something in the pipeline or something that you plan to do, then taking those factors into account and fixing it for the right length makes it very crucial.
I think what you said there's quite important, that no one knows what's going to happen with rates. So we've not got a magic wand to tell you which is the right one, but it's always what makes you feel most comfortable.
More comfortable, yeah.
Cool, thanks, Rav. Darren, what about yourself? What sort of conversations are you having?
Just touching a little bit back on what Rav was saying about future plans. Another scenario might be that you bought a property, you're now finally on the property ladder. However, the property needs a lot of work. However, you don't have the funds to do that right away, but it's something that you might want to consider doing in about 2 years' time. And therefore it would be better just to fix for 2 years. So then at that point you're able to remortgage, raise some capital, carry out the works, etc. But yeah, I mean, equally, if you bought a property that doesn't need any work and you're quite content with, you like to budget, and rates are at a reasonable level to what you think, then it might be an option just to fix for 5 years, and then hopefully think about it at that point. Yeah. It's all about attitude towards risk and what your future plans are.
Cool, yeah, perfect. Thanks, Darren. And obviously you said there that they might want to do the house up. Is there any other future circumstances that people should consider?
Yeah, certainly if you've got children, for example, and you know that you've got a plan for them in terms of whether it might be school fees, etc., you would obviously base your level of fixed, whether it's 2 or 5, according to that, and generally around where your future plans lie, etc.
Perfect. Thanks, Darren. Steve, yourself, what's your sort of main takeaways from conversations with clients around 2 versus 5 year fixed at the moment?
At the moment, it's quite a tricky one because obviously post lockdown, COVID, etc., rates are all over the place and they're quite high. A lot of clients I'm speaking to are very tempted by the 5 year fixed rates because they're a lot better value than the 2 years at the moment, and there are quite a few good deals for the 3 year fixed rates at the moment. 3 year fixed rates aren't something we usually come across very often, purely because not all lenders offer them. So they're not usually as good a value as you'd think. You'd think they'd sit somewhere in the middle of a 2 and a 5 year fixed rate, but they're priced more towards the sort of more expensive end, and you don't really get much out of it. So a 3 years is very much, if you know you're going to want to fix for 3 years, be in the property for 3 years, then it's a good one to go for. Otherwise, it's not the best value usually. However, saying that, there are a couple of lenders at the moment who are offering 3 year fixed rates at the same rate as their 2 year fixed rate. So it is quite a good option to go for at the moment. So I'm having quite a lot of conversations with clients about 3-year fixed rates as well. But essentially, it's always up to your situation, your circumstances. If you're gonna only be in the property for 2 years, or you think the rates are going to improve for 2 years, then 2-year fix is the way to go. However, if you want to budget and you don't think there's going to be much change in the next 5 years, or you've got big changes coming up, then it's good to fix in for the 5 years and be completely unaffected by the market.
Perfect. Thanks, Dave. Would you say that, obviously I always think that how long you plan to stay in the property can sort of have an effect on how long you fix it for, because if you know you're going to move out in 2 or 3 years, would you then take a 5-year fixed?
Yeah, good question. It's always best to speak to a broker in that situation, because, like David said, if you're intending to move out in sort of 2 years or 3 years, or even 4 years, and you fix in for 5 years, some lenders will let you port your mortgage. There's lots of criteria around that, and you're treated as a new client, basically, a new customer of that bank or building society. So you can potentially port your mortgage, or we can look at deals that potentially don't tie you in, so they're a bit more risk, but they don't come with early repayment charges. Early repayment charges are something that lenders put in place on their mortgages. If you end that loan agreement early, that mortgage early, you're going to be charged typically sort of anywhere from 1% to 3% of the loan. The tracker rate mortgages tend to come without any of these early repayment charges, but they're not fixed. So they do track the Bank of England base rate, so a bit of a risk there.
Cool, thanks, Steve. Darren, Steve just mentioned porting there, and it's sort of something that I think in the mortgage industry as brokers we know obviously what porting is and sort of what it does, but what would your explanation be of porting, and should it play a factor in when deciding how long to fix in?
Yes. So, for example, as Steve was saying, if someone is looking to move, but rates are really low, and you see a knockout 5-year fixed that's got a super low rate,
Yep.
and you have plans to move in 2 years, and whether you're downsizing or upsizing, you have that ability with a specific lender, if they allow it, to port your mortgage, essentially take that deal that you've secured, a 5-year fix, for example, and take it to a new property. However, as Steve touched on, there's a lot of criteria around that. So always speak to your broker about that. And if that's part of your plans, also mention that right from the outset. But yeah, it's definitely a lot of lenders do offer porting.
Well, thanks, Darren. Rav, what's your obviously views on porting? It's something that we're sort of seeing quite a lot, isn't it, with people on low rates already? Yeah. What's your sort of overview on porting and whether it's something you should consider when recommending a fixed?
Porting these days is a very default feature with many lenders. And I think it's a very good feature to have on a mortgage. It kind of gives you a little bit of flexibility whilst you get the security of a fixed rate. So yeah, absolutely. If you get like a fixed rate that is super cheap or super low, it's a great deal to have on, as long as you're going to port to another property. And that is providing to a degree where your circumstances do not change, i.e., it might be difficult to port a mortgage if your income changed, for example, the affordability is in question, then lenders still are within their rights to decline porting. So for clients, it's very important to understand that whilst it's a good feature to have, it's not a specific right as such. You're not default. But by default, you can't just simply port. You're going to still have to meet certain criteria.
So essentially, sorry, Rev. So essentially, you have to still meet the qualifying criteria, go through an application. You're just moving the rate from one property to another.
Absolutely.
Cool, perfect.
Just to touch on that point, actually, the whole point of porting is that you'd actually avoid early repayment charges.
Yeah.
So that's the whole, if you port your mortgage, you will not be subject to any early repayment charges by that specific lender.
Cool. So with porting, essentially, you're tied to the product, but not necessarily the property.
Correct.
You can port it from one to
in a nutshell, yes.
Cool. Thanks, Dezo. Rav, let me come back to you on this one. So at the minute, we're seeing that 5-year, Steve said this earlier, actually, that 5-year deals a better value.
Yeah.
It's historically, it's always been the other way around, hasn't it? 2 years
Yes.
has been the cheapest. 5 years has been slightly more expensive for that security.
Yeah.
Why do you think 5-year fixed are better value now? Why are lenders offering better rates on a 5-year fixed?
So if you look at what the UK economy was in recent times, where we had like a really high inflation, and to combat that inflation, one tool that Bank of England has is to control the interest rate. So if you up the interest rate, it makes it expensive to borrow, which means it reduces the spending. In other words, it reduces the demand and therefore reduces the price. That's the general idea of it. So interest rate were up. The way mortgages are priced are based on something called swap rates. And the swap rates are actually a market of actual transactions taking place, but they're looking at the sentiments of what the future rates would be. So now that we're seeing the interest rates starting to come down a little bit, although Bank of England is still holding the rate, but we're seeing the inflation starting to come down, the market sentiments are that the future rates are not going to be what they are currently today.
Okay.
So therefore the 5-year outlook on the economy is a lot better than what the current outlook is today. Although it changes very frequently, but that's what everybody feels in the market, that 5 years or 10 years time, the UK economy will be in much better place. So therefore the products are being priced accordingly. So in next 2 years, there's a little bit of instability as such, or a little bit of volatility, because there could be a change in government coming up. We don't know how the trade impacts the UK economy as such. And therefore, the short-term view is that it's a little bit risky.
Yeah.
Therefore, the mortgage rates are up. But the 5-year outlook, it's a lot better, and therefore the rates are a little bit lower.
Okay. Cool. Perfect. Thanks. That was quite a nice overview there. Darren, what are your... Again, it's a tricky conversation with a customer when, well, my advice would be to take a 2-year fix at the moment. Given what Rav said, there's a bit of an uncertainty in 2 years, then rates potentially come down longer. What do you say to a customer who wants the best value deal, which would obviously be a 5-year fix with a lower rate, versus why you think a 2-year might be better suited to them?
Again, it always goes back down to what their future plans are. That would be basically the forefront of where our advisors brokers lie.
Yeah.
So that's always like priority, where they see what their future plans are. Is there any financial circumstances that are going to change in the future? That's where our advice would always be based around. Now, if you get a customer who's just looking for the best rate at the moment, 5-year fix does hold that. However, there, as Rav just touched on, there's a lot of instability at the moment in the market. Change of government could sway things positively or negatively. We just don't know. And it's basically, where does people's risk lie in respect to that? At the moment, people are going for a 2-year fixed purely because they want to try and get back to where the rates were historically 4 or 5 years ago, or pre-COVID, where rates were super low. Yeah, people are trying to get back to that. So going for a 2-year fix allows them to review the market again in the short term rather than the medium 5-year term. So
I think it's important to have that conversation with customers where what would make you feel worse, having a 2-year fixed at a slightly higher rate now, but then coming out in 2 years and renegotiating to a better deal, or if you take a lower rate 5-year fixed, you're fixed in for that for 5 years. If rates do come down in that period, you can't really do anything because you've got an early repayment charge of normally, 3%? So it's definitely something to factor in. And I think it's quite a hard conversation when a customer always sees a better rate, a lower monthly payment. They think that's the best deal. But as Rav said earlier, the best rate's not always the best deal.
And just to touch upon that, if you do go for a 2-year fixed, that means you'll have to remortgage again. And as everyone should know, really, that remortgage has its own set of costs as well. You've got legal fees, you've probably got a product fee that lenders like to chuck on as well. So, you've got to weigh up the true cost of a transaction like this.
I think another interesting, I think it's Virgin have got the 5-year fixed with 2-year early repayment charge, haven't they? So you could take a 5-year fix, have that security of knowing what your payments are for 5 years, but after 2 years they waive the ERC, so you can switch to another product. You can't remortgage, but you can go to like a new 2-year fix or 5-year fix if the rate's lower after 2 years. Cool, perfect. Rav, what about, obviously we're discussing 2-year and 5-year fixed. Stephen touched on it earlier. Why are 3-year fixed never really prominent or talked about as much as a 2 or 5-year fix, do you think?
Yeah, it really comes down to the choice availability in the market. like many lenders, there are very few lenders who actually do it.
Yeah.
And therefore, when you are trying to compare the size of availability that you have, it doesn't really provide much of a value. And many times it's a case where a 3-year is priced very close to what a 5-year is priced, or a 3-year is priced very close to what a 2-year is priced.
Yeah.
So that's why it didn't always stand out in the market as such, because it did not hold its own category of a particular price range. I think also, not what I've found with many clients is that the plans are either near terms or long terms.
Yeah.
The mid-term plans are not as such very thought through just yet. So therefore, most people have clarity on what will happen in 5, 7, 10 years time, right? Or what's happening near future, like going self-employed or having a child or starting a new job or something like that. The middle-term plans are always a bit flexible, isn't it? That's why the 3-year fixed is not is not very prominent as such.
Darren, what's your thoughts on sort of where a 3-year fix sits? Because obviously we always find ourselves talking about 2 and 5-year fix and never really about 3-year fix. So what's your sort of thoughts on that?
Yeah, so with as Rav just touched on briefly, 3-year fixed, not all lenders provide them. So if a normal customer is wanting to have a look at the whole of the market or wanting to have to get several different lenders, you're not always going to get that with a 3-year fix. You're just going to get a handful of lenders that actually have availability for products in that market. Typically, a customer goes onto a comparison website. They're only going to see 2 and 5-year options. No one really has that 3-year fixed option. So again, speak to an advisor. If you have plans that are going to materialize in 3 years' time, you know that definitely you're going to move in 3 years' time, then a 3-year fixed is probably going to be your best bet. But just bear in mind that there's only going to be a few lenders that are available in that space. As Rav touched on, it's more about your short-term and your long-term goals. Just basing the advice around that.
Cool. So basically, the lack of competition, it means that there's not really competitive on price, which is why they sort of never really offer generous rates. Is it? That's my opinion on it. Cool. Let's sort of touch on sort of sticking with the fixed theme 2 versus 5 years. Let's talk about when a client comes to remortgage him. Darren, what are you seeing in terms of? Obviously, they've got 2 options, haven't they? They could stick with their existing lender on a 2, 3, or 5, or go to a remortgage 2 year, 3 year, or 5. What are your thoughts on that? What should a customer do, and what's the best way to go about that?
Sure. So a lot of people, a typical customer might get confused by the terminology. First of all, so if you're looking to stick with your existing lender, or you're already, say for example, you're with Santander at the moment and they're offering a deal on a 2-year fix, you're essentially doing a product switch or a product transfer. If you're looking to change lender completely, that's the whole remortgage, and there's a whole legal process with that. It's obviously naturally quicker and cheaper to do a product transfer. However, what we are seeing right now as brokers is that it's better to at least review your options, speak to a broker, and see if there's any better deals out there rather than sticking to your existing lender. Right now, at the moment, there is a lot of competitive rates out there. So always speak to an advisor. If the opportunity arises, always speak to a fee-free broker. That way you're not tied in, there's no pressure, and you can just basically review your options.
Cool. So essentially what you're saying, it makes total sense, is just check the market, make sure, because you could be getting a 2-year fix from your existing lender, but it might not be the best deal on the market.
Yeah, and if you're going for a 2-year fix and it turns out that there's better rates available, not to quote figures, but you could be saving hundreds here by just simply remortgaging to a new deal.
Every little helps.
Every little helps, correct.
Rav, I'll come to you on this one. So obviously we've got a situation where someone's took a 2-year fix, they've come out. How do you approach it? What's your sort of view on looking at a product transfer, as Darren explained what it is, or a remortgage?
So if someone's coming out to your fix, the first thing we want to look at is what's your current bank offering, right? And that becomes kind of a baseline of comparison. You can go to the market, or we'll go to the market and have a look at, are there any better rates comparatively cheaper than what your current lender offers? And then it makes decision making a little bit more simple, right? Because now you know that your own bank is offering X, the new bank is offering slightly bit cheaper. You then make you as a client would then make a decision whether you want to stay with your current lender or move to a different lender, although there would be a little bit of paperwork involved. But that could mean that you save 20, 50 or £100 a month.
Yeah.
My recommendation is always going to be go with the cheaper no matter what, because mortgages are spread over longer years. So even a £10, £15 a month difference in your payments would mean a lot in long run.
Yeah.
Plus, it's a £10 saving that you're currently not making one. So
Yeah.
my default option is always going to be that. But as a customer, you may prefer ease
Yeah.
or the value of time of doing all the hassle of remortgages. But that's where we come in place, right? We at Reside Mortgages, we don't charge any fees.
Yeah.
We do the legwork.
Yeah, I think what you just said there is quite important as well to touch on when you said about ease, because sometimes customers, as much as you can plan ahead, they might leave it a little bit late. They might they might come to you and say, my fixed rate is ending in 2 weeks, 3 weeks. What can you do for me? In that situation, what conversation you have with them other than telling them they should have looked at it earlier?
Yeah, I mean, the first thing is about planning, right? So it's ideal. The best thing would be to plan a little bit ahead. So today you have a mortgage offer. You know that your mortgage offer is expiring in July. Save it on your calendar for the coming 2 years, in 18 months time that your mortgage is coming up, and get engaged with your broker. And that would help you avoid that kind of situations, effectively where you have really no choice but to stay with the current lender.
Yeah.
So really it's come down to how good you're planning at. So generally, our clients that we have done in past, we will make sure that we get in touch with them 6 months, 4 months, 3 months, as a basis of urgency when it comes to their remortgage. So they can avoid that kind of situations.
Cool. Thanks, Rev. Darren, what's sort of your view on obviously timings and stuff? Because if we always say we want to get the client the best deal, but if they do come to us with sort of, I've got 2 weeks left, 3 weeks left, a product transfer is normally better for them to do, isn't it? Because it will just avoid them going on to their standard variable rate.
Correct. So when you hit the standard variable rate, you know that your interest rate's gone from whatever it is to something that's absolutely eye-watering. So you want to avoid that at all costs. So yes, if you're 2 weeks away from your deal ending, the best option is probably going to be to do a product transfer, unless the rates that they're offering, it's completely not worth it. Again, this is where your broker is going to come into play. They're going to work around with the numbers. They're going to see what's going to be best for your situation, and whether actually going on the SVR for 4 or 5 weeks, one extra higher monthly payment against getting a better deal with a new lender might actually be worth it in the end. But yeah, timing is crucial. Just touching back about the remortgage, a typical lender will give you a 6-month mortgage offer. And even if your lender is offering the best product, you can even secure a product transfer rate 6 months before your deal ends. So yeah, it's better to get these things done early doors, because if rates do improve, also here's another common misconception: once you secure a rate, you're not able to change from that.
Yeah,
completely wrong. If you secure a rate now, and then we wait 2 months later and rates do improve, we can go and secure that rate, the next best rate. It's never going to be a situation where you're tied in because you've simply fixed too early. So don't worry about that. Always get in touch with the broker. They'll know best.
Cool. Fail to prepare, prepare to fail.
Correct.
Rav, we've sort of touched quite a bit there on fixed rate deals. Obviously, there is another type of deal on the market, a tracker.
Yeah.
What is a tracker, and why would a customer take a tracker rate?
Yes, so tracker rate is effectively a rate of mortgage that you have that tracks a Bank of England base rate. So say your mortgage rate is 4%, 1% is actually bank's interest rate. That doesn't change, but it's tracking the Bank of England base rate, which currently, let's say, is sitting at 3%. So if the Bank of England increases the rate from 3% to 4%, your mortgage rate increases by 1%, which goes up from 4% to 5%, right? And the reverse is also true. If the Bank of England reduces that rate, you will see an equal proportion reduction on your rate. It's actually a very good product to have, because many trackers, and I stress many, not all, comes with no early repayment charges, which means it gives you a flexibility. Now, for who would take this kind of products? If your income is highly variable, which means, for example, for some years, some months you would have a really good bonus coming up, and you want to overpay on your mortgage. These kind of mortgages allow you to overpay, so eventually you can pay off the mortgage in fairly soon. If you are someone who again is a bit adventurous, who knows that the rates are going down and you want to capitalize on the going rates rather than being fixed on a particular rate, tracker rate helps you that. But effectively, it's the flexibility that the tracker mortgages provide is what people generally go for. But it comes with its risk.
Cool. Thanks, Rev. Darren, come to you on this one. Obviously, we've discussed fixed rates quite heavily so far. There is obviously a tracker product available. How would you describe a tracker, and why would you sort of be advising on a customer taking a tracker?
Sure. So there's a number of reasons why a client might be inclined to go towards a tracker. Again, it's based on individual circumstances. For example, a client is a high income earner. They get quarterly bonuses. They want to make overpayments. And just a little bit on overpayments. When you make an overpayment, it actually tackles the principal amount of the mortgage. There's no interest, so it's actually just knocking off the capital of the actual mortgage itself. So if you get somebody who's got quarterly bonuses and they want to start making overpayments, they're able to do so with a tracker simply because there's no early repayment charges typically with these types of products. Again, your advisor will be able to tell you which products that are trackers have ERCs and which don't. So and another reason why a client might want to go for a tracker is that where rates are currently, and if they have plans to move, for example, that are not quite materialised, they could happen at any point. They might want to go for a product that doesn't have any early repayment charges, and therefore they're able to leave without incurring any charges. So that's another reason why somebody might want to go for a tracker.
And obviously you said there about rates. I mean, a lot of people looking at base rate now, they expect that to go down. So I'm just saying that's another reason people take a tracker, just if rates go down, they'll benefit from a reduction. As
we've seen in the news that inflation's coming down, and there's a lot of speculation out there about the actual Bank of England reviewing the base rate, and hopefully, positively, if it comes down, it's going to have a knock-on impact on rates itself.
But then I suppose there's always that risk as well that, as Rav said, if it goes up, then your payments are going to go up. So you've got to sort of be aware of the risk of it going up and as well coming down.
Correct, yeah.
Steve, back with us. Hi, Steve. So obviously we've still talked a lot about fixed rates today, 2 versus 5 year. There is another sort of product on the market in a tracker. What is a tracker, and sort of why are customers taking trackers?
A tracker is a variable rate of interest, so it's not fixed. It can go up and down, and it will track the Bank of England base rate. So, for example, if the Bank of England base rate is 5% and your tracker is 1% above, you'll be paying 6%.
Perfect. And what type of customers are taking trackers, and what sort of situations would you advise a tracker in?
Trackers typically come without any early repayment charges, so they won't tie you in. So people who want to overpay by more than, you usually get a standard allowance of about 10% overpayments on a mortgage. So if you want to overpay by more than that, somebody with large bonuses, regular bonuses that they want to chip away at their mortgage on a regular basis would take a tracker. People who are moving potentially within a year or so, or within a few months would take a tracker because they can repay in full without any charges. Or someone who thinks the base rate is likely to go down in the next couple of years would gamble on a tracker and hopefully benefit from a lower mortgage payment because of the lower interest rate within those 2 years.
Thanks, Dave. I think another thing that I find, and I'm not sure if you guys find it as well with trackers, is sometimes, we discussed like porting, someone's porting, or they've taken additional borrowing for home improvements, and they've got 2 parts of their mortgage that finish at a different time. Yeah. Is that sort of another reason why a tracker might be attractive? So you can sort of essentially run them. If one comes out of a fixed rate, you can go onto a tracker to sort of run it down and line them up.
Yeah, absolutely. If you do move and end up porting your mortgage or taking some extra borrowing, The lender you're with will usually put that on a separate rate of interest, and it will have a separate end date as well. So you have two parts of your mortgage ending on different dates. If they're within a few months, 3 to 6 months of each other, the one thing that we as brokers do is, if your lender allows or offers trackers without any early repayment charges, when that first part comes to an end, we can switch you over to a tracker. You'll be paying a variable rate of interest for the 6 months, so it is a bit of a risk if rates do go up. And because of the no early repayment charge, we can line up the second part and do another, either a product transfer with the same lender to a new product and roll both parts together. So you have the same end date, or we can roll both parts together with a new lender via a remortgage, and you'll have just one mortgage again with one end date.